Uh, Everybody, welcome to another Throwdown Thursday with two Einsteins. Two Einsteins are in the house, Adam Boatsman and Jack Santaniello. If you saw the post that we put up last night, you'd understand. If you haven't, go see it. You can find it on LinkedIn. So anyway, hey, we got some questions already that have come in, which is great. I can always count on Vicky and Mike to give us good questions, and they have not let us down, which is great. So just a reminder, everybody, you know what to do. Hit the Q&A. We got plenty of stuff to cover, even though there's not much new coming out of Washington. But we are in the throes of tax season, if you haven't figured it out. Also, shout out to Clean Juice. I'm going to go there after this is done and get probably a berry bowl or something like that. But it's kind of a crappy day out here, so I need to celebrate with something. So it's going to come from Clean Juice today. So shout out to you guys who are always on this as well. So thank you. So Adam, it looks like you got something on your mind. So and I saw your email from earlier today, which is really good. So you might want to participate.
Yeah. So to quote the Fantastic Four, flame on! No. So, as I was getting ready for the webinar, Gary said, hey, let's make sure that we're hitting on taxes because it's tax season. And it reminded me, so I will apologize about getting political on you for a minute. Actually, I won't apologize, Gary, about getting political on you for a second.
You're going to do it anyway. So
yeah, it just reminded me that I had an unanswered outstanding question to my state senator and my House representative, Jeff Tart and John Bradford, respectively, who I know personally fairly well. And that was basically, guys, what are we doing with the taxability, with the deductibility of expenses in North Carolina? Related to PPP. And just so everybody knows, it's not just PPP. I mean, pretty much everything that's favorable to either a business or an individual with respect to the federal tax code associated with the CARES Act. This applies to student loan interest. It applies to mortgage principal indebtedness and debt forgiveness associated with it. It applies to SBA loans. It applies to PPP, all of it. North Carolina's position is all taxable. Whereas our friends right across the border in York County, not taxable. What's even funnier is, who North Carolina is in good company with? The evil empire of the state of California. But who has pending legislation that I didn't check to see if it passed or not? The great state of California, to fix all these problems. So yeah, thanks, Ray. That's what I was talking about. Even freaking charity we're taking away in North Carolina. So it's just ridiculous. So I got, the tone of my email this morning was it wasn't professional. I'm not going to sugarcoat it.
I thought it was pretty good, though. Honestly,
It was personal, but it didn't cross, it wasn't respectful in the sense of, the honorable and all the terms that I should have used. It's pretty much Jeff and John freaking do something about this. It's ridiculous. You call yourselves Republicans. And basically stop calling me a freaking liberal. I'm fiscally conservative and socially neutral. Cut it out. You can't even make a case that this is fiscally conservative, other than if your position is the state should get more revenue so they don't have to borrow more money. I suppose that is conservative. But last time I checked, that's the opposite direction of what the principles of limited government were supposed to stand for, and helping small business out and offering up tax breaks. So it just, I would encourage anybody that's on the webinar or listen to this afterwards. I mean, it is like in November, December, it was kind of funny, they'll probably do something. Like, it's no joke now. We're filing tax returns right now, having to advise people on payment amounts, extension payments, setting up their extensions for next year. It's no joke, and it's real money. I mean, it's basically going to be 5% of your PPP proceeds plus 5% of whatever the SBA forgave you, plus whatever happened on the personal side is money that North Carolina wants to take from you that other states would say, no, we're not going to take that from you. And that's permanent money, period. Like, it's not a timing difference. Like, at least where North Carolina deviates from the federal tax code in other areas, like depreciation, that's just the timing difference. You're going to get the deduction anyway. In this case, that money's gone, period. It's going to the state, not in your pocket ever. So, and there's nothing I, as a tax professional, can do about it because there's no magic tax planning scenario where I can do one thing on the federal side and another thing on the North Carolina side. So, in Senator Chart's defense, he did email back that I just saw in the last 15 minutes or so with effectively, yeah, that sounds pretty crazy. I'll forward it on, but not like I'm totally aware of the situation and I'm on it. So that makes me a little bit nervous. So I did forward that out to maybe a few of my more vocal business owner friends that I know these two guys personally, to perhaps maybe weigh in a little bit more on the subject to lend credence to the voice. Shout out to my brother-in-law Dale, who did pile on because I copied him on the email. He's way more tactful about that stuff than I am, so he had a much more professionally worded statement than I did. So that was good. But I think related to that, the other thing to be forewarned on, it's actually a position that I would have a tendency to agree with because it's consistent, at least with other provisions of the tax code, and that's with things like the employee retention tax credit and the FSCRA. Just remember that is going to be taxable income. So, and there's probably not going to be anything that happens on that. Like, do I think that ultimately North Carolina, there's a chance they might do the right thing? Probably, but it's looking less and less likely by the day. It seems like one of those last minute game day. They were late to the party on even allowing, like, North Carolina last year waited until the last freaking second to say that you could extend a return. Federal government had taken care of it long before the state of South Carolina had taken care of it long before the North Carolina had taken care of things. So, could something happen at the last minute? Yeah, that seems to be the way that our state operates is last minute. We've now been shamed. We'll finally do something about it. But it's not, it's not helpful at all. But the tax credits, I mean, we've had some clients run the calculations on the tax credits that had the ability to go backwards, and it's some pretty serious money. But just remember, it's going to be that'll probably be that is taxable income, and I don't see anything changing on that front. I know that the also on politics, stimulus package continues to move. Sorry, my last shameless thing. We had time to figure out how to censor Richard Burr, but we don't have time to figure out how to put money in my pocket. That's the last political comment that I'll say about all this. So that's what drives me crazy. So, I haven't seen too much that's changed really relative to the stimulus package that's moving through now. Have you, Jack?
No, and thank you for, I'm sufficiently warmed up in my freezing cold office uptown now, which they can't figure out the HVAC. So
they need to get climate systems over there, man. I'm telling you.
Gosh. I mean, it's amazing. And then I'm afraid that the fire marshal is going to show up and find my hypothetical illegal heater that is under my feet that is not in existence. So anyway, but no, I mean, there really hasn't been a whole lot of news on this. Other than I know that clients are having challenges or receiving notices from the banks that say, we'll let you know when it's go time. And that's pretty much it. And so, they're saying, get your documentation together, make sure you got your numbers together. And I did see on the banking side, and if there's any bankers on the line that can corroborate this, but that there are some technical bulletins and other things coming from Treasury and the SBA for guidance on how to handle certain things, and meaning processing, and also providing, I don't think a full set of get out of jail free cards, but moving more towards and reaffirming their position that we are not going to hold the banks, meaning the government, is not going to hold the banks accountable for fraud unless it's blatantly obvious and they should have seen it, meaning that it all falls back on the borrower and their certifications that are essentially under penalties of perjury, that they applied for it correctly, and they applied for the loan correctly, and that they have applied for forgiveness correctly, and subject to maybe some miscalculations. But they also made it clear that they're still watching. They're focused on the higher dollar amounts, the 2 million and higher, but there's the middle tranches of loans that have gone out that they will be reviewing. I speculate that they're putting together algorithms that will just put applications through a electronic, maybe artificial intelligence process. Not to get all sci-fi techie, but I mean, there is technology that would go through and say, all right, look at these variables, and if they're within a certain range, and if the math works out correctly, then everything's fine, and it may kick out some for further review. So everybody just remain on your best behavior, use your Excel spreadsheets to back up your manual calculations that you're doing with pencils and on green paper, and all is good, supposedly.
Yeah, I think the only other tax thing that I think that I've seen come up as well is on the unemployment rate. We did have a few clients that emailed in and said, hey, I just got my new rate and it's ridiculous. I thought that this whole COVID thing wasn't supposed to impact my rate. And they are technically correct. Like, everything that we saw was that any unemployment in this time frame, you basically got a pass on having it influence your rate one way or the other. So I guess all I'd say is that if people are starting to get rate notices that their rates are going up pretty dramatically, please forward them on just so that we're aware of them, just so we know what's actually happening out there with the state unemployment office. What I would say, though, a case where the rate could have gone up and it's perfectly legitimate for it to have gone up is that, if you remember, like, if you're a brand new company, the unemployment office just says, you're a new company, you have no experience with us, therefore your rate is a set rate. I can't remember what it is, but it's a pretty low rate. Well, if you had a whole bunch of claim activity that occurred prior to the pandemic, and then you had the pandemic happen and you didn't have a lot of claim activity, that rating change likely was created due to what happened prior to the pandemic when you had a lot of activity, because your account wasn't full. So, if you do get a notice, it could very well be that it's driven by a period that occurred before the pandemic, even if you didn't have that much activity during the pandemic.
So I just got this in from Vicky. Vicky, you've been on it today, man. I really appreciate that. Bank of America sent her a note today. PPP loan forgiveness portal is now open. Woo! So there you go. Bank of America, good for you. She also said that she's got a friend that's an North Carolina state rep from North Carolina, and their position is that the expenses will not be deductible, and the thought was they don't think that they're going to be anticipating a change to their position for now. So I hope she's wrong. Then let's go ahead and
sorry, another political statement, a little bit hypocritical then, don't we think?
Yeah, I agree. So keep lighting the fire, man. And you're doing it. I think you did it in a pretty respectful way. I wish everybody could see that letter because it made me laugh, but I thought it was good. It wasn't derogatory, and it was emphatic because we passionately care about small businesses and mid-sized businesses that are privately held.
Right.
So that's just our passion. So this is from Vicky as well. Got this yesterday. So she had asked about our calculator, which we released to a bunch of people when it was still 8 weeks and before all the various machinations that came down the pike. And so AICPA has updated their calculator last Thursday. So Google AICPA PPP loan forgiveness calculator, and you should find it. But anyway, that's readily available for people, and she found it to be helpful and much better than what they had before. The first one was not user friendly. This one is. So here's the question she's got. I believe I've read where hours of part-time employees qualify for sick leave tax credit. Do part-time employees also qualify for family leave tax credit?
I don't know the answer to that question off the top of my head. My gut feeling would be probably, but I will look it up after the call. The reason that I would get to the probably answer is that, first off, it just meets the intent of like, hey, we're paying people when they're sick because they had COVID. That was the whole point of the credit. But independent of that, the arrival at the calculation for FMLA, I believe, in the first place, which is what all this is based on, is all based on looking at what's an FTE, which is an hours-based calculation, not like in other words, originally ACI, I think, kicked in, or FMLA kicked in at 50 people before they changed, and it still is 50 people. And they just changed the rules around when you had to offer it. But, it wasn't that you could have like 500, fractional employees that always were 500. I believe it was those 500 fractional employees all sum up to equal 50. Therefore, you're subject to FMLA. But I will double check that and make sure that we get it addressed, Vicky. But my gut feeling is yes, they would qualify if you otherwise met the FTE criteria in the FFCRA.
My 2 cents is I think that what you said is correct, but I also am not an FMLA expert. But there are instances where depending on what you're talking about, whether it is a full-time equivalent or if it's actually, someone who is whether or not you can combine the numbers to get to full-time equivalents, or is it really a person that is a full-time person based on 37.5 hours per week, whatever the number is. So Adam, if you don't find the answer, I will find the answer down the hall with my employment law partners.
Gotcha. I was trying to stall long enough that you can get off camera and go find out.
I don't even know if they're here, so.
That's right.
Oh, and by the way, you can't see this. Hey, you can sort of. This is the new, it's the light on my phone. There. It's the new Bic lighter for concerts, right? That you put it up there. So yeah, I'm heating myself up with that.
Good job.
That's good. Yeah, just be careful for spontaneous combustion.
Yes.
All right. Next question is from Mike. Good to see you here. Thanks for sending this in, Mike. Question on ERTC. For this month, it looks like we'll get a credit for ERTC of about 60 grand, a $60,000 reduction in debits from our bank account from our payroll company. However, the employer portion of our Social Security tax for this month will be $20,000 approximately. My question is, how do we account for this on our financial statements? Would we debit our expenses by 60 grand, thereby increasing our net profit for the month of February by 60,000?
You got the debits and credits wrong, but What you'd end up doing is the expense is still the expense. So you still incurred the expense from a financial statement reporting standpoint. So that's a debit. The credit would be an other income item because it's one time in nature. Therefore, it's other income that would be added back. So it wouldn't affect your EBITDA, but it would affect your bottom line. So your EBITDA would remain the same, it'd be just like as if you're operating, but your bottom line would go up by 60 grand with the credit being another income item because it's, it's one time in nature.
All right. Next question is, when calculated gross receipts for a for-profit, are you able to include cost of goods sold? We're going back and forth with our bank.
Well, gross receipt, that was really confusing language. Basically, they're trying to say that gross receipts was not gross profit. They're trying to say gross receipts was gross receipts. So it's truly sales, period, not a decline in gross profit. So when they said includes cost of goods sold, that wasn't to say like sales is 100, cost of goods sold is 50, therefore I have 150 for my test. It really was sales were 100, period, not gross profit was 50 versus gross profit was 25. So it's not really meant to measure decline in gross profit. It's meant to measure a decline in sales.
All right, cool.
And there's a bit of a nuance too with that when we talk about, or when it's talked about cost of goods sold, and some questions have come up as to when you talk about, can you put things into cost of goods sold related to increase in expenses of manufacturing and things like that. And you really need to look at the increased number, the list of things that are included as part of loan forgiveness. So you talk about things like supplier costs, you talk about protective measures, personal protective equipment, and those kind of increased costs, which are operational costs and not necessarily linked to the production of the product that is truly a cost of goods component. So I've seen some, where does it go in this particular issue as far as being covered as forgiveness where it wasn't covered under the first set of provisions for the loan.
All right, next question is from Ray. I applied for and got my first draw of PPP last summer based on average payroll from 2019. Now I'm going back to the same bank to apply for round 2, and they're telling me I can't use the same numbers from 2019.
That's actually incorrect.
What's that?
I mean, that's just incorrect, but go ahead.
You might want to find a different bank. All right, so let me finish this. They say they are requiring 941s from 2020. Since our payroll was way down for 2020, that would mean I could only get about half of what I got the first time. All the guidance I've seen says that the borrower can choose either 2019 or 2020. Can they do that?
Well, I mean, remember, it's ultimately the bank's decision to let you borrow what they want you to borrow or what they're going to allow you to borrow. So, if they're doing a restriction, that's because they don't. So in this scenario, sorry for being long-winded here, but it helps to think through the scenario that's occurring here. You had a high payroll cost in 2019 that created the amount that you borrowed in 2019. And then, for whatever reason, now your employee count is 75%, maybe it's 50%. You still got full forgiveness on that 2019 amount because the duration was longer. You got the 24-week cover period. So you're covering, in theory, less people, but the same absolute payroll dollars. It's just the time window was expanded. So in 2020, payroll's down for the purposes of measuring, 2.5 times an average month's payroll, because it would be if you have less people. Makes total sense. So the bank's position is likely coming from a position of, I'm going to only let you borrow less. I'm going to have you borrow less because I'm worried that you won't be able to spend it all. And I'm going to get stuck with a loan at the end because your payroll, which is the fundamental base of the calculation, is down. Therefore, I want to loan you less because I don't want to have money that wasn't forgivable hanging out at the end. So we had some clients that happened to in round one that even though they were eligible for amount A, they were actually given amount B because the bank was just worried based on the nature of their business, they wouldn't be able to spend all the payroll dollars when it was still an 8-week calculation. So they just shorted them relative to what they could have received. So my suspicion is that's the position the bank is taking right now with you. The bank's not technically correct. The bank has the flexibility to choose which way they want to pick. And it seems like they're picking a super conservative approach, I don't want to be in the business of servicing a loan at the end of all this, which is shortchanging you money that you could have otherwise been due. It kind of sucks. I mean, in this case, I probably would just cut and paste the language and say, help a brother out. This is the way I'm reading it. This is what my CPA said it's supposed to be. I don't understand why, who there made this decision? So at least you got him on record saying, yeah, we understand it's BS too, but it is what it is. Versus, we have had cases where, especially in round one and even in round two now, where banks have said, oh yeah, thanks for bringing that to our attention. We screwed that up. Now we're going to fix it.
Yeah, it sounds like it's a self-imposed qualification of, are you truly in need? If they think that the numbers are going to be different because of exactly, that maybe 2020 was better than you anticipated, and so maybe you don't need it as much as the others. But the only thing I would say that might be improper is that if they are not being consistent, in other words, they're picking and choosing who they are imposing these different calculations on and doing it in a prejudicial way potentially, but you wouldn't be able to prove that very easily at all. So the easiest path forward is to go somewhere else where to a different bank.
There are plenty of good ones out there. UCB has come through, and not to pick favorites, but I'm just saying that those guys in Pinnacle have come through when some of the big banks promised and did not deliver. So Thomas McTeer over at UCB in particular has come through in a big way. Same way with Brian Red over at Pinnacle. So, all right. Josh says, can you clarify what we will be considered? What we will be considered an eligible expense regarding the vague cloud computing items. Would items like email marketing systems count?
I don't think so, but maybe. And so I think the reason that the expansion was to deal with not only remote working, I think that was the original intention, which was setting up, buying the video cameras, buying the programs, getting your licenses for Zoom and other stuff. But it also is expanding into your processes for providing the products and services. So if you have to go to some sort of automation, or if in a warehouse or whatever it may be, so those things I think count. But to the marketing aspect, a lot of it was already electronic and that kind of thing. So while I see and I don't know the true answer, definitive answer, but I don't think that would be included, because that's something that was already available. And unless you might be able to say, well, we had a sales team of 100 people out there, and now they got benched. And so this is the alternative way of doing business. So it's a legitimate expense versus saying, well, we were going to up our marketing game anyway, and this was just a mechanism to do that. So I think that you might have to, again, this is a Jack theory, show a disruption to your normal operating procedures that caused you to purchase this as a substitute in order to continue doing business, is if it were allowed. But I don't know off the top of my head if something like that, and I haven't seen any guidance that is that granular and specific as to this software application or program versus this type of software application or program.
Yeah, I would tend to align with Jack. I mean, it was really meant to, the spirit behind it was to help out with the incremental costs associated with getting somebody to have the ability to work remotely. There's no like broad definition that says you couldn't include it, but it's one of those like, we're a HubSpot user. So it'd be hard for me to like stand up before the judge and say, we had HubSpot before the pandemic, we had HubSpot after the pandemic. I'm throwing HubSpot in. Technically, we had Salesforce and then we switched to HubSpot.
Yeah,
but you get the point.
We did make the switch. Josh had another question, a follow-on. It says, is there any benefit to waiting to file for forgiveness if you had a loan under 150,000 for the first loan?
No, man, I go get it off your plate. One less thing to do at this point.
I would say with one exception though, that if there's still capacity, like you didn't max out your loan or you gave some money back, because once you actually get the forgiveness, then you're no longer eligible in that pool of the first set. So you can't get a second draw on the first set. So you'd have to go to the second set and follow all those qualifications. So I think that would be the only exception, which probably is not likely. Probably under 150, you got everything that you were going to get or permitted to get, likely.
So this next one's from Mike. Question on ERTC for 2020. Part of our business is installation of our equipment at customers and assembly beforehand at our company. Due to governmental orders, we limited the amount of people in our building at any given time. Due to this, we had to reduce the hours for this part of the business by 2 hours per day for a period of 6 months. Would this qualify us for a partial shutdown in 2020?
Well, I think if it's the same Mike that I'm thinking of, I think that, yeah, well, I mean, your employee count was such that you were going to qualify regardless of whether the people were working or not. So for you, it really comes down to the gross receipts test in a given quarter. So if you pass that gross receipts test in a given quarter, which is going to be the 50% down, you're off to the races in terms of claiming the credit. I think, with you specifically, Mike, and this applies to other companies out there as well. We aren't recording this, are we, Gary?
We are. It'll be on the BGW YouTube site later on.
I'm just kidding. No, I mean, I'm not, don't commit any super big shenanigans, but if revenue recognition is somewhat subjective, or you had a scenario where, hey, it really could have gone either way. Debbie issued the invoices on June 30th because she was leaving town, where she normally could have issued them on July 1st. And you're on the bubble of that 50% reduction due to one of those things that it's like, hey, that really could have gone either way. I don't see a beef in making the switch in your systems to demonstrate the 50% down. If it was if it was really on the bubble and it could have been a call either way, and it just so happened that just based on when a Friday fell, as an example, we did it one way versus the other. I mean, that seems close enough that I would be willing to stand up in court on that one.
All right, good. All right, here's the next one. Since April 2020, our 5 partners, 7.5% owner of an S Corp, have taken a 50% reduction in their W-2 pay and still continue on with that reduced amount today. No hourly wages were reduced during this time. Will this affect our FTE and loan forgiveness?
No, because as long as you spent the money, you spent the money on wages. It would not have reduced your FTE count anyway, because the people are still working, they're just getting paid less. And with owners specifically, owners were part of a separate pool of people that got carved out of the forgiveness amount. So A, there was a max amount they could get paid anyway. And B, it couldn't exceed the amount of the 2019 numbers. So this is off the top of my head. but I'm pretty sure in the FTE reduction quotient number, they're not even in the grid that you count for that purpose, which the FTE reduction quotient has two elements. Element number one is I reduce people, which people could be a function of also reducing hours. Or number two is I made people take pay cuts below 75 grand effectively. Like in other words, the bar was 100. As long as I paid them up to $75,000 on an annualized basis, I was still in the green. So those are on the circumstances. And off the top of my head, I don't even think owners are in that grid to even be part of that calculation in the first place. So I think you're probably fine.
All right. Next one is it true that the retention tax credit doesn't allow us to use the same payroll period as PPP covered period? What if I choose the 24-week covered period, but my expenses exceeded the PPP amount? Can I use the excessive amount for the retention tax credit?
Watch last week's webinar. I'm just teasing. So I'll give you a Jack theory, since he's coined the phrase now, and I'm going to piggyback on top of it. You know, the IRS is supposed to issue guidance about taking the credit retroactively. They haven't done it yet. So the pundits, myself included, believe that the correct interpretation is that even if you're in the PPP covered period, then any amounts in excess that you didn't need become monies that are eligible for the employer retention tax credit. And if you kind of think about that logically, you know, the business has tanked. I got some PPP funds. I still want to keep the team intact, and I'm going to keep on paying them because I haven't exhausted my cash yet. I've exhausted PPP. Now I have this tax credit available. You're still paying people and employing them to qualify for the tax credit in the first place, in lieu of them being on unemployment, which is the whole point of the tax credit's existence. So, you know, using round numbers, you know, if you got $1 million, I think this is the exact example that we used. If you had $1 million, you only needed to have deployed 600 grand to meet the 60-40 ratio. If you actually spent 700, we believe that 100 is the piece that you're looking at for the purpose of this credit. Now, the IRS could come out and say, nah, it's BS. The only thing that matters are wages after the cover period. You know, maybe they'll say that. I don't think so, because it doesn't make sense. So we think that the answer is yes, it qualifies, but there's not been any guidance that's been released about this. So it is pure Jack theory.
You can call it Adam theory if you want. I won't be offended. I don't have a monopoly or trademark or copyright on it, so you're good.
I like Jack theory, and we'll just stick with Angry Adam.
Okay.
Sounds like a cider. Anyway, so since the covered period has been extended to 24 weeks, must we use the exact 168 days to calculate payroll expenses, or may we fall short of those numbered days to help with calculating our days within the end of a pay period?
No, I think all the guidance had that you can use a prorate amount. If you spent the money, you know, sometime after 8 weeks, but before the 24 weeks, you just use that amount. It's just that you need to use a prorated version of the $46,000 for the salary test. In other words, you can't say, you know, I'm going to use 12 weeks for my forgiveness period basis of calculation, but I'm going to use a 24-week period for the salary test. Like, they just have to be consistent on those. This is specific to the wage reduction.
All right, this is a PPP2 question. We received our PPP2 loan last Friday. Awesome. So when does the covered period start? Does it start the day we receive the PPP loan, or can we start the 8 or 24 week period later? trying to maximize ERC credit for the first and second quarter of 2021. It'll take us roughly 2 months to spend the PPP money. Therefore, the goal is to use ERC for January and February, then PPP loans starting March that will likely run out by the end of April, then picking up using ERC again after PPP is exhausted. Hope this makes sense.
I will use my slowest voice so Jack can look it up while I'm talking. But, I think it's probably, my gut feeling would be it's going to be consistent with PPP 1, which is either the date that it was funded or the date of your first payroll after it was funded. So I think you're stuck with those two options.
And I'm wondering, when you say, does it mean to say the forgiveness periods start with respect to receipt of the loan? And
Yeah,
versus,
I think that's what the question is. Like in PPP round 1, your covered period started either upon the date of the funding of the loan or the next payroll cycle for administrative ease of performing the calculations. I don't see a reason why PPP 2 would be different. I just don't know the answer off the top of my head.
and I haven't seen anything differently than that. And I don't have all of my stuff in front of me right now, so we'll go with that.
Jack.
Sorry.
Yeah. So in this person's case, you would pick the later date, the funding date of the next payroll, which in this case is probably going to be next payroll, which may not push all the way to March, but at least buys you a little bit more time.
All right. Next one is, can I apply for PPP forgiveness if the businesses didn't do well when I applied for it, but they're in good condition after the covered period?
Yeah, I mean, that's a lot of people. So you're not alone in that. I mean, I think we have observed that, it literally is a bell-shaped distribution curve. It's kind of 25%, we're actually up. There's this vast middle that was flat. And then, the 25% is like, it was hell. So you're, so that's great. You're in that 25% bucket. You can still apply for forgiveness because the whole thing was you didn't know that at the time.
Yeah, and otherwise it might serve as a penalty for good behavior. In other words, you thought you needed the money, and you, at the same time you're applying for the funds, you implemented processes, you kind of trimmed the fat, you did certain things, you didn't take as much pay home, or whatever it is that were reduced, that you didn't know would be reduced, or you didn't know the impact of it. So I think it would be unfair, Jack theory, that to penalize people who did the right thing in kind of self-preservation, and say, well, as it turns out, didn't need it because of your good behavior. It's kind of similar to what we talked about many weeks ago about, did you need it to begin with when you have to make that certification? When we're talking about, the IRS started saying, well, we're just going to come and start looking at everybody and see if you really need it. And if you realize you didn't need it, you have until X date to give the money back. And people started panicking. Well, and then the questions were, well, what if, there was money in the bank, it's an S corp, I was taxed on it, I just decided to have kind of my own retained earnings, which may be an increase in the capital count technically, and but the money's there, I don't need it. Or what happens if I have a line of credit, and those kind of things available to me, am I going to get dinged? So similar concept in theory, that to look back retrospectively in the crystal ball and say, well, I didn't need it, I think would be just an unjust penalty to those who did the right thing.
All right, this next question is from Phil. If an S corp owner owns 2 companies in separate industries, is the $100,000 wage cap per company, or total between the 2 companies?
Total between the 2 companies. They shut that barn door in one of the FAQs a while back.
Yeah, there's affiliation rules between them that are in the background. I mean, it could be the case that, if it wasn't a true affiliation, and you have a W-2 earner, well, let's say it's, I don't know, husband and wife, husband on one company, wife on the other, they file a joint return, but they're separate employees, but there is a kind of relationship between the two. So there's affiliation rules that you need to deal with as well. But yeah, they're trying to make sure that obviously people don't double dip by having separate entities that are really kind of divisions rather than separate affiliates.
All right, so the next question actually is kind of a two-part. On the loan application as well as the loan forgiveness application, they're asking for numbers of employees. Is FTE associated with this number? I'm not sure that I understand the question really clearly.
Yeah, I mean, that is what they're asking, is what's your head count?
And it's FTE, not part-time.
Yeah, it's what, like we talked about before, which is, you could have a lot of part-time people, but when you add, that just with lower hours versus having more full-time people with more hours. And so you're able to, for various reasons, combine part-time people to create this imaginary full-time equivalent persona.
All right, cool. Any other questions out there? This was a good, lively group. Oh, yeah, we got another one in here. So paying rent to related parties with a signed lease in place. Does this mean I can only deduct the interest on their mortgages as my rent for my loan for forgiveness?
Yeah, totally unfair, but that's the rule. And if you didn't have a mortgage because you were responsible and the building was all paid off, you're stuffed. I mean, it sucks, but that's just the answer. I don't know why, but that's the answer.
All right. Any other questions out there, folks? This has been a great example of why Einstein supposedly did say this about filing tax returns. This is too difficult for a mathematician. He was no ordinary mathematician. It takes a philosopher.
He did have some quote. Yeah, he did have some quotes about income taxes that I found quite interesting.
And it's true. It does take a philosopher. You better be able to do some math.
And I'd like to point out that I think the Federal 1040 at that point really was a true 2 pages. Not what it is today. So.
Oh my goodness. I think he is also, I heard him quoted as saying, simplicity is the essence of things profound. That would be a very true statement, whether he truly said it or not. It's a great statement. I wish our government could figure that one out.
Right.
All right. Well, we've had a great crowd today. Any other questions before we sign off? You guys have been great. Adam and Jack, you lived up to your reputation of kind of Einsteins, as far as I'm concerned.
Aim to please, buddy. Aim to please.
All right.
Well, I do want to thank you for, since you brought that up, that the Little Einsteins theme song for kids, for those of you who have kids that are sort of in that age, is running through my head every time I hear that word now. So thank you for that.
We're going on a mission. Start the countdown. 5, 4, 3. Oh yeah, I watched a lot of that, Jack. I watched a lot of that.
Mm-hmm.
Yeah.
Okay.
I'm gonna have to kill you now.
Hey, misery loves company, so congratulations, welcome to my mind.
Yeah.
Oh my goodness. Well, everybody, just a reminder, if anybody came in late on this thing, we will have this thing posted on the BGW CPA YouTube channel later on this afternoon. Thank you. Keep those questions coming. We plan on being back here next week because we're still in tax season. Even if nothing changes on PPP, we clearly have lots of confusion still out there. So we are here to help you guys. Thank you for being here. Thanks for what you do to make our country great. We appreciate each and every one of you. Signing off. Have a
Bye.
good
Thank
See you guys.
See ya.
All right. Bye.